What if I told you that China's currency system operates fundamentally differently from most major economies? Unlike the dollar, euro, or yen, the yuan's value isn't primarily determined by market forces. Instead, the People's Bank of China literally sets the daily exchange rate and enforces strict capital controls limiting money movement. This system, with its $50,000 annual limit on foreign currency purchases by Chinese citizens, creates the perfect conditions for potential manipulation. But does having the capability mean they're actually doing it? Before we dive in, please subscribe to our channel, like this video, and turn on notifications to stay informed about our latest content. The mechanics of currency manipulation. So what exactly happens when a country manipulates its currency? Politicians often throw this term around, but the mechanics behind it are actually quite straightforward. When we look at the US dollar, its value is determined by market forces. Millions of daily transactions between buyers and sellers across global currency markets establish what a dollar is worth relative to other currencies, creating a supply and demand mechanism at a massive scale. China's yuan operates differently. The People's Bank of China actively sets a daily reference rate, around which the yuan can only fluctuate within a narrow 2% band. This functions like a speed governor on an engine, placing strict limits on how fast or slow the currency can move. This gives Chinese authorities direct control over their currency's value in a way most developed economies don't have. This control extends beyond daily rates. Chinese citizens face strict limits on converting yuan to foreign currencies. Just $50,000 annually per person. This cap prevents large-scale capital flight that could naturally push the yuan's value lower. When citizens can't freely exchange their currency, market pressures that would normally adjust exchange rates are effectively neutralized. Behind this system stands China's massive war chest of foreign exchange reserves, approximately $3 trillion worth, with a significant portion in U.S. Treasury securities. These reserves give the PBOC tremendous firepower to defend or adjust the yuan's value. When China wants to prevent the yuan from strengthening, it can sell yuan and buy dollars, increasing yuan supply while building dollar reserves. To put it differently, the practical effects of currency valuation on trade are substantial. Let's break it down. When the exchange rate is 7 yuan per dollar, a Chinese smartphone that costs 2,000 yuan to produce? That's about $286 for US importers. Meanwhile, an American laptop that costs $1,000, it'll cost 7,000 yuan for Chinese consumers. But if the exchange rate shifts to 8 yuan per dollar, that same Chinese smartphone now costs just $250 in the US, a 12.6% drop. And the American laptop? Now it costs 8,000 yuan in China, a 14% increase. Building on this, currency manipulation functions remarkably similar to tariffs, just from the opposite direction. While tariffs directly increase imported goods prices through government fees, currency manipulation indirectly achieves similar trade advantages by altering the underlying exchange rate. Both tools ultimately shift the competitive landscape between countries' exports and imports. The crucial question remains: does China's capability to manipulate its currency mean it's actually doing so currently? This assessment requires more nuance than political rhetoric suggests. Economists have developed an objective three-part test to identify currency manipulation. A country must maintain a significant bilateral trade surplus with the United States, show a pattern of accumulating foreign exchange reserves, hold reserves exceeding what's needed for 3 months of normal imports. This framework provides an objective basis for evaluating manipulation claims beyond political accusations, focusing on measurable economic outcomes rather than just exchange rate movements. China met these criteria from the early 2000s through about 2013, rapidly accumulating foreign exchange reserves while maintaining large U.S. trade surpluses. Textbook currency manipulation behavior. However, since 2014, China has frequently spent reserves to prevent the yuan from weakening too rapidly, essentially the opposite of manipulation for competitive advantage. This shift reflects China's evolving economic priorities, moving from export-driven growth toward domestic consumption and financial stability. Evaluating Trump's claims against economic reality. While China's recent currency practices have evolved away from devaluation strategies, Trump's rhetoric continues to frame the economic relationship in outdated terms. The data reveals something remarkable. During periods when Trump escalated his tariff threats, the yuan's movement against the dollar often contradicted his fundamental claims about manipulation. Let's examine Trump's specific accusations. In his campaign rhetoric, he's claimed China effectively imposes a 67% tariff on American goods through a combination of direct tariffs and currency devaluation. According to Trump, whenever the U.S. imposes tariffs on Chinese products, China weakens its currency to offset the impact, negating any American advantage while maintaining China's competitive edge. While Trump's claims stirred public debate, the official assessments tell a more nuanced story. The Treasury Department's stance on China's currency practices has fluctuated significantly over time, revealing the political dimension of these accusations. During Trump's first-term presidency, his administration officially designated China a currency manipulator, a dramatic shift from the Obama administration's more measured approach. Obama's Treasury deliberately delayed its annual report on currency practices to encourage China to allow the yuan to appreciate naturally against the dollar. The historical exchange rate data provides critical context. Following the July 2018 implementation of Trump's first major tariffs on $34 billion of Chinese goods, the renminbi weakened from about 6.3 to the dollar to over 7 to the dollar by August 2019. This surface-level movement might appear to support Trump's narrative. However, examining the broader timeline reveals that over the past 2 decades, the yuan has actually strengthened significantly against the dollar, making Chinese exports more expensive, contradicting what a country seeking unfair trade advantages would want. Perhaps most revealing are China's active interventions to strengthen its currency. Market pressure in recent years has predominantly pushed toward a weaker renminbi, yet China has frequently worked against this tide. In January 2022, for example, when most emerging market currencies were weakening, Chinese authorities implemented measures to bolster the yuan. This directly contradicts the accusation that China deliberately devalues to boost exports. Among economists, perspectives on China's currency policies vary significantly. Renowned economist Stephen Roach presents a compelling counter-narrative, arguing that the U.S. Treasury's reports perpetuate the U.S.'s denial of its own role in fostering global imbalances. Rather than focusing exclusively on China's currency practices, Roach suggests America should address its own economic challenges that contribute to trade deficits. China's economic objectives now prioritize domestic consumption, financial stability, and developing high-value industries. This evolution naturally affects their currency management. Stability has become more important than competitive advantage through devaluation. The political context surrounding these accusations cannot be ignored. The label currency manipulator serves as a powerful political tool regardless of economic reality. Trump's accusations appear designed to achieve political objectives, rallying support by identifying a clear foreign adversary while simplifying complex economic relationships. The evidence indicates that while China possesses the capability to manipulate its currency, their recent interventions have often worked in the opposite direction of what Trump claims. Rather than pushing the yuan down, Chinese authorities have frequently acted to prevent excessive weakening, effectively supporting a stronger currency that would benefit American exporters and consumers. Conclusion: as we've seen, the economic relationship between the United States and China transcends simple narratives. Their mutual dependence, with each being the other's largest customer, means currency disputes have global ramifications. As the world's 2 largest economies, their relationship dwarfs even Germany, the 3rd largest economy. Currency disputes represent a critical facet of broader strategic competition. The Trump administration's accusations emerged from viewing China as a paramount threat to American dominance. Understanding these dynamics requires both technical analysis and geopolitical context. In this global chess match, how might currency policies reshape tomorrow's economic landscape? The balance of power hinges on these financial tensions, making our understanding of them increasingly consequential for our future. What do you think? Let us know your thoughts in the comments below.